Good morning and welcome to today's learning module on investor readiness. So today I will be giving you some tips on how to ensure your business is best placed for investment success. My name is Diane Brown. I'm a Chartered Accountant and Business Advisor with SRJ Walker Wayland. And I'm passionate about educating business owners such as yourselves on the importance of planning for business success and working with you to ensure you achieve your growth and profitability goals. So today I'm taking you through on some of the key components you need to become familiar with if you are considering taking on an investment source to help scale up and grow your business. So today's workshop will predominantly focus on early stage entities that are pitching for further investment. For more mature businesses that are interested in exploring the different ways to exit a business, including selling all or part of your business, please refer to the earlier learning module, Selling and Valuing Your Business, that was recorded by Sean Reeves from SRJ Walker Wayland and Tony Brown from Divest, Merge and Acquire. So in terms of today's workshop, what I would like to take you through is the sources of potential funding, the importance of having your value proposition correct, how to go about identifying and quantifying your market opportunity, talking about the importance of understanding your management capability, understanding what's required in an execution plan, and discussing with you the various exit strategies and valuation methods that you might want to consider. And we'll wrap it all up with the 10 elements that all investors want and that need to be included in your pitch that you make for investment. So as I said earlier, there are a lot of different sources of funding. So you can have internal funding, which is from your owners, management, employees, banks, that sort of thing, which is maybe for some of the more immature businesses. What we are going to focus on is external investment sources for some of the more advanced startups that are looking to scale and grow, either through equity investment, through sophisticated investors, venture capitalists, or potentially even grant funding through some of the larger grant funding programs such as the Accelerating Commercialisation Federal Program or the State Business Development Fund. So we will focus on external investment sources. On the PowerPoint resources that I have provided you, there are a number of different summaries of the types of external investment sources that you could consider, including angel investors, venture capitalists, private equity, crowdfunding, and equity crowdfunding. What I do want to point out is that the information requirements of your pitch and your information memorandum are going to be similar for whatever source of funding you're applying for. However, the focus will be slightly different because the focus needs to be on what the funder's requirements is. So therefore, some of the data might be slightly different that you include in that documentation. For example, if you are looking for investment in the form of a government grant, the focus on your pitch in that area will be around jobs and growth, economic and community development, and your ability to deliver the project like you say you will. If you're going for external investment through sophisticated investor networks, venture capitalists, etc., then their focus will be on return on investment. They'll also be looking at how much equity they will be receiving for their contribution, whether there will be any dividends payable to them and when, what the exit strategy is for yourself and for them, and more importantly, your ability to deliver and do what you say you're going to be doing. Regardless of which type of funding you're applying for, all funders will be looking at comparing the potential return on investment versus the risk associated with that. So in terms of planning for investment for your company, it's critical that you engage advisor support early to ensure that you are developing the pathway for the value optimization of your business. So that means engaging with your accountant, with your lawyers, with specialists in various areas, but particularly around the areas associated with structure advice, because it's important that you get your structure set up first and get it set up early to enable you to facilitate the framework for investment. For example, if you're looking at equity investment, you need to be ensured that you're set up as a company structure. If you're thinking about safe notes or convertible notes, again, you want to be in a company structure. You could also look at whether you're going to issue units in a unit trust. There are a number of different ways that you can structure your business to ensure that it's available to facilitate that extra external investment. You also need to make sure that that structure involves a consideration of the tax consequences, both for yourself of the initial investment and also potentially for your funder. And it's also important to consider the eligibility criteria for tax incentives if you can be classified as an early stage innovation company. Additionally, you need to ensure that you have your intellectual property protected, and that means accessing IP advice early to ensure that you are safe and protected before you go any further in terms of your public investment requirements. So the first step in that process in terms of getting your business investment ready is developing your value proposition. So this means thinking about how will you deliver value to both your customer and also to your funder. So to work out your individual value proposition for your business, you need to think about what it is about your product or service that is innovative. What is the sustainable competitive advantage that is attached to your product or service? So you need to be thinking about why people will buy your product. What identified need or issue is it addressing? And what are the benefits that go with your product or service? Does it save people time? Does it save them dollars? Will it boost other business performance? Will it remove the risk associated for businesses in particular industries? So the benefit of your product needs to be linked directly to the need that you've identified that exists in the market. And it's important that you obtain independent evidence to verify your value proposition. So I've also given you a little PowerPoint template to get you started on developing your value proposition. So it simply considers answering 5 key questions. So think about what your product or service name is and how that reflects what you actually do. Make sure you consider what essential benefit or gain your customers will receive from utilising your product or service. Who are your customers and where are they located? And how is your product or service solving their problem or a particular pain point in this particular way, in this better way than it's currently available on the market? In terms of developing your value proposition, you also need to consider any spillover benefits of your product or service. And this would include things such as increased collaboration between businesses and research institutions. For example, if you're developing a Meditech advice that's going to collate data from a whole range of patients from different demographics, what could potentially be done with that data? How could research institutions such as universities and governments benefit from the data that your project or your product or service can actually obtain? How does your product or service increase the international profile for a particular industry or market? And you need to think about some of the benefits associated with the diffusion of knowledge and skills that may be associated with your product or service. Does your product or service or your project rely on supporting other industries? For example, if you are looking to develop a particular device or product that requires manufacturing, will you be using an Australian-based manufacturer and therefore be in the supply chain and supporting another industry that's separate to yours? Are there any upskilling requirements for that staff of that Australian-based manufacturer? So you need to think about not just the key benefits to your business, but the spillover benefits to the broader economy in general. It's really important when you're looking to grow your business and requesting further investment to do that, that you've clarified your market opportunity in terms of dollars. So that means looking at who your demographic target is, what size that market is in terms of dollars, and if you're considering exporting, what is it locally in Australia, what is it internationally, how your product or service is scalable to be able to tap into that market, and what is the expected market share for your product or service in either the local or international market. You also need to be thinking about, are there any barriers to entry for your product, and how are you going to address those barriers to entry? And there's a number of different resources that are available that I've made available on the slides to help you develop your skills on how to go about that market research. And there's a great book that's available. It's called the Mum Test book. And what that does is it takes you through some of the key things that you might want to consider when asking questions or developing surveys to help identify and validate your market. So speaking of validating your market, it is really critical that you have some data around your market's willingness to purchase your actual product or service. So this means you might want to attend some industry conventions where you are asking people to respond with an expression of interest in your product or service, or even better, a potential order for it. It might be doing some Facebook stats. It might be some surveys through SurveyMonkey. You could even use Facebook, etc., where you're validating some of the key assumptions about your product. But once again, independent verification is critical to ensuring that you can make potential investors feel more comfortable with the risk associated with investing in your business. The next thing that you need to consider is your management capability. So what skills and expertise do you have, and those that are already in your business, to ensure that your project or your product or your service is a success in that particular market? What gaps do you currently have? And how are you going to go about addressing these gaps? One of the great ways that you can do this is to consider having an advisory board of people that are specialists in areas that can mitigate the risk associated with the gaps in your own capabilities. Your execution plan is fundamental to ensuring your investor has comfort around the potential risk associated with investing in your business. So this means including your business strategic plan. Make sure you have one, make sure it's documented, and make sure it's authentic. This means ensuring your business structure facilitates investment. This means that you've mapped out a project plan of how you're going to achieve the growth that you say you are going to achieve. For example, if we think about an early stage company such as yourself, a funder is going to be focused on the future growth and evaluating the risks associated with obtaining that future growth. So they are looking at forward projections, and they have in the back of their mind what risks are associated for this particular business, your business, in terms of achieving that future growth and hitting those financial milestones. So your financial forecasts, your pathway to positive cash flow is critical in terms of an external investor looking at your business. So you need to have your financial model right. How are you going about obtaining sales? What have you got in your sales pipeline? What are your sustainable margins? How long do you achieve positive cash flow? Your project activity needs to be detailed around milestones, your budgets linked to your financial model. what the key deliverables are at each stage, so that they can see throughout their investment that you are on track to achieve your growth. They're also going to be particularly focused that you have your IP rights protected. So what are your IP rights? What is the underlying IP for your business, and how have you gone about protecting that? And they're also going to want to see a risk analysis that includes mitigation strategies for any of those identified risks. Because investors' key focus is on the return of investment, for a new business, the valuation is going to be based on their perception of the likelihood of the return on their investment. So if you're considering going down the investment path and you're an early stage entity, you may consider approaching investors from a similar industry to yours, because they will be more comfortable with the risk because they know your industry. You also want to be considering sophisticated investors. What they're also going to want to see is what the exit strategy options are and why you've come up with the type of exit strategy option that you actually have. So for example, have you provided a pathway for yourself, if that's what you want, and the funder to actually exit this particular business and draw down on the growth that they are receiving as a result of their initial investment? So when are they going to be able to do that, and how are they going to be able to do that? Are you planning an initial public offering or an IPO? Are you planning a merger in 2 to 5 years? Is there a buyback option, or is that something you would consider? So you need to be thinking about the different exit strategies that are available and doing analysis on the pros and cons of each, and have addressed this in your execution strategy. In terms of valuing your business in order to determine the amount of the funding or capital contribution you require, there are a number of different methodologies available. And as I said at the beginning of this workshop, there is a whole separate learning module available on how to sell and value your business. So I don't want to spend a lot of time going through this, other than to say, for existing businesses or mature businesses, the return on investment is based on their future maintainable earnings that are based on how well they've earned or how well they've performed over the last number of years. For early stage companies, it's based on the potential of your future maintainable earnings. So we come back to the importance of the nailing your financial model, your financial assumptions, and mapping out your path to positive cash flow. When you are looking for investment, you are going to be required to do two things. One is pitch, and that might be in a number of different forms, and I'll talk about that in a minute. And the other one is to map out your equity requirements or your funding requirements in what we call an investment memorandum. For both of those components, there are 10 elements that all investors want to see. So the first one is people. They want to know that you are passionate about what you do, and that you're passionate about making your business a success, that you have the commitment, the experience, and the synergies available to be able to do that. So one of the key things they'll look for is you and how you perform in your business and your pitch. The second thing they're going to want to see is your value proposition. So they want to make sure that you've clearly articulated how you have identified a need, solved that need in a unique and new way. They want to make sure that your intellectual assets are protected and that they're differentiated from what else is available. They want to make sure that they're comfortable with your financial assumptions, and that's linked to your market and your customers. So are you correct about your market size? Who are your customers? Where are they? What are the barriers to entry? What are the competitors out there that are already in the markets? And how is your product different to those? And what is the potential market size in terms of dollars for your product or service? They want to make sure that that your business is structured correctly for investment. So that means looking at, as I said at the beginning, company, unit trust, but for most of the situations, you're looking at equity investment. So that means shares. So they want to be aware of the different share classes and voting rights that are attached to that. They want to know about the future dissolution of ownership. So are there going to be any additional equity contributions that might dissolve their their shareholding in that particular company, or dilute it, I should say. They want to know how you're going to structure the contributions. Is it going to be convertible notes or safe notes, which is a simple agreement for future equity, very similar to convertible notes. They want to know that your growth is achievable, that it is maybe initially a rapid, or is it more staged growth? They want to see that you have a clear strategy and the pathway to achieving that growth. And 9 times out of 10, they also want to know, well, what's the international vision for this company? As I said earlier, the financial model is really, really important. For external investors, they're also looking for the potential tax benefits. So it's more likely to be attractive to an external investor, such as a venture capitalist or a sophisticated investor, if you're able to access or if they're able to access tax incentives through the early stage investment scheme. They're also looking for a strategic fit. So how would the investment they're going to make in your business fit within their existing core business or portfolio? And they want that exit strategy. So they want the value creation path, they want that pathway for return on investment, they want to know how they're going to get their money back, when they're going to get their money back, and what your plan is for them to get their money back, and what the growth on their money back or the return on their money back is actually going to be. And they want hard data. So they need independent, verifiable evidence. So when you think about all those 10 things, you've got to pull it together into a pitch. So in your pitch, you need to be addressing each of those 10 key characteristics. So what's your problem that you're solving, or the unmet need that exists in the market? What's your solution to that market problem? Who's going to benefit from your product or service? So who's your customer? How big's the market and how can you scale into the market? What's your wow factor? So what is different about you that is better than any other product or competitor that's out there? Why will they be interested? How will it make money? How do you know all of this? And what's your pathway to market? And more importantly, what's the timeline from proposal to funding contribution to profit? How are you going to get there? What's your sales methodology? What's the exit strategy? And how much do you need to make this all happen? Usually in terms of a pitch, you want to have a PowerPoint supported by a detailed investment memorandum. So there'll be 2 key documentation requirements that you're going to need. For some really good examples on pitches, I've provided a link to some pitches for some startup companies before they came famous. And it gives you some really interesting background, and it shows you the pitches that companies like Uber, Airbnb made to get their initial equity funding and be able to scale up their businesses to the multinationals that we now know are available. So I hope that gives you some insight in ensuring that your business is best placed for investor readiness. So today we've discussed the sources of potential funding, the importance of nailing your value proposition, the importance of quantifying your market opportunity. We talked about your management capability and what you can do regarding addressing the gaps in your existing capabilities. We talked about the various components that are required to be included in your execution plan. We talked about the importance of considering the different exit strategy options for both yourself and your investor. And most importantly, we talked about the pitch nailing the 10 critical elements that all investors want. So thank you for listening to me today. I hope that ensures that you are better placed to access funding contributions from external investments. So that was my Investment Readiness 101. Thank you very much for listening. Bye.